Welcome to Alpha Insights. I'm Jeff. Today we're digging into the world of penny stocks, the low-priced shares that can move fast and make headlines. With me is Drew, a tech sector analyst who watches small-cap markets closely. Drew, good to have you.
Thanks for having me, Jeff. Glad to be here.
Quick note for listeners. If you have questions as we go, you can ask us at stockalpha.ai. We answer listener questions live. All right, let's start simple. What exactly do people mean when they say penny stock?
Sure. Regulators generally describe a penny stock as a share trading under $5. But the real point is that these are usually micro-cap or small-cap companies with limited liquidity and less reporting. So low price alone doesn't tell you much about the business.
So it's more about size and disclosure than the dollar figure itself.
Exactly. You can have a legitimate company under $5, and you can have a shell with virtually no revenue at the same price. The key things to watch are market capitalization, free float, filings, and trading volume.
People are attracted to penny stocks because of the leverage, right? Small capital, big percentage moves.
Right. That's the appeal. A small account can buy a large share count and see big percentage swings, but you pay for that in risk. Intraday moves can be huge, spreads can be wide, and getting out can be difficult if nobody's on the other side.
Let's talk about those risks in plain terms.
Sure. First, volatility. These names can move 10%, 50%, or more in a single session. That means winners can be big, but losses can be sudden too. Second, bid-ask spreads are often a large portion of price, which increases trading costs and slippage. Third, low liquidity. If average daily volume is tiny, your order can move the market. Fourth, disclosure and business risk. Many penny names have thin reporting, frequent accounting changes, or come from reverse mergers. And finally, manipulation. Paid promotions and pump and dump schemes are common.
That sounds like a checklist for disaster if you aren't careful.
Yeah, that's a good point. But there are ways to trade responsibly if you choose to participate.
So walk me through a practical framework. If someone is going to step into these waters, what should they check before hitting buy?
Start with a pre-trade checklist. I'd look for names listed on major exchanges when possible, NASDAQ or the New York Stock Exchange, because those listings generally mean better disclosure. Check average daily dollar volume and free float. As a rough rule, analysts tend to prefer stocks with a float and volume that lets you exit without moving price. For many traders, that means a float greater than 50 million shares or healthy dollar volume.
And filings?
Yes, read the latest quarterly and annual filings for revenue, cash runway, and debt. Look at insider ownership and recent share issuances. Frequent dilutive financings are a red flag. Validate any press releases. Independent coverage beats a sponsored article every time.
Give me quick examples of how this plays out in the real world.
Scenario 1. A microcap biotech posts preliminary trial data and the stock rockets from 60 cents to $2.50. Momentum traders pile in, price spikes, then profit-taking and wide spreads push it back under $1 over a couple weeks. If you bought late, you could get squeezed.
Ouch. And scenario 2?
Scenario 2 is the classic pump and dump. A thinly traded reverse merger stock gets a promotional campaign. Price climbs from 10 cents to $1 plus. Promoters and insiders sell into the spike. When the promotion ends, the stock collapses back to pennies. The Securities and Exchange Commission has acted on many of these cases.
Makes sense.
And scenario 3 is the liquidity trap. You size a position assuming you can exit, a bad result comes out, bids vanish, and the best offer is a fraction of your cost. You either accept a huge loss or you hold into more uncertainty.
So execution matters a lot. What are the practical tactics traders use?
Limit orders. Always. Market orders in thin names can create massive slippage. Cap position sizes. Many traders limit a single penny stock trade to between 0.5% and 2% of their capital. Use stop losses and consider time-based exits for momentum plays. And importantly, avoid holding speculative microcap positions overnight or over the weekend, when news can gap the stock.
Any common mistakes that trip people up?
Yes, buying solely because the share price looks cheap, ignoring spreads and slippage, chasing promotions, concentrating too much capital in one name, and skipping basic due diligence. Those are the usual culprits.
Quick reactions. Good checklist. Discipline needed. Always read filings.
Right.
Before we wrap, any final practical tips for listeners who want to learn without risking too much?
Practice with very small sizes or paper trading. Build a checklist you won't skip. Study historical pump and dump cases and regulatory enforcement to spot red flags. And remember, data suggests most speculative trades fail, so capital preservation should come first.
Great summary.
Honestly, I was a bit surprised how many traders underappreciate liquidity risk. It's the single factor that causes the most pain.
Noted. Okay, let's close with 3 key takeaways for listeners.
Number 1, price per share is not value. Focus on market cap, float, filings, and credible catalysts. Number 2, control execution and risk. Use limit orders, strict position sizing between 0.5% and 2% of capital, and stop loss or time-based exits. Number 3, watch for red flags, paid promotions, sudden volume spikes without independent news, reverse mergers, and frequent dilution.
Those are solid. And a reminder, this is informational. Analysts note risks and patterns, not personalized investment advice.
Exactly. Treat penny stock exposure as a speculative sleeve of capital and prioritize preservation.
If you have questions about anything we discussed today, you can ask us directly at stockalpha.ai. We answer listener questions live. And for more market insights, head over to stockalpha.ai. Thanks, Drew.
Thanks, Jeff. Great conversation.